So this has the potential to make things very uncomfortable for the ultra-wealthy in America. Here's a sliver of an inside look into the shady world of hedge funds and private equity, and how pending legislation dealing with life insurance could deal a pretty heavy blow to both industries. If you're confused why I'm out on the water picking up trash, this is our actual job. We are an insurance advising firm. Cleaning and restoring the Chesapeake Bay is the mission. Briefly talk about what hedge funds and private equity firms are. These are groups of wealthy investors who pool their money together with a firm that usually has one general managing partner, similar to how you would buy shares of a corporation. Except most hedge funds and private equity companies are not structured as a corporation. And that's because one of the main benefits of investing in these types of firms is that the profits come to you in what's called pass-through taxation. So when a limited liability partnership, a limited liability company, an S-corp, like hedge funds and private equity are often structured through, profit received by the firm is then passed on to the investors. The firm does not pay taxes on this profit like a corporation would pay a corporate tax rate. Simply dole out the earnings as unearned income. Because it's unearned income, the investors of course don't have to pay Social Security or Medicare taxes. Unlike a corporation where that money is either being paid out as a dividend, which gets taxed at a dividend rate, or as a salary, which of course includes both those taxes. Investors in all structures of course have to pay income taxes. But if they're a limited partner in a pass-through entity like a hedge fund or private equity firm, there will be some portion of business losses that they can use to offset that income. Where does life insurance fit into this somewhat complicated scheme? Well, the ultra-wealthy have one main goal they all often share, and that's to lower their taxes. Of course, life insurance cash value can accrue tax-free. So what they will often do is purchase very large life insurance policies, often up to $1 million in initial premium. These policies are known as private placement policies, and what they do is they actually invest the cash value of the policy into a hedge fund or private equity of your choice. Like we said, life insurance accrues cash value tax-free. Normal investment of capital would see your returns actually taxed at least on the income. However, the returns that the cash value inside of the hedge fund accrues within a life insurance policy, of course, accrue tax-free. So not only does this mean that the investor gets to accrue wealth without actually paying taxes on it, of course, they also don't have access to it. More importantly, it means they can use these policies to lower their taxable estate, because life insurance policies can be placed inside an irrevocable trust, which means the person that policy is on actually doesn't any longer own it. Trust own it, and the trust is basically considered its own legal entity. Trustees are usually the insured's family, the estate. As long as the insured does not have incidents of ownership, life insurance policy can be paid out to the trust without being included in the taxable estate of the insured. Which means that the several million dollars that the insured originally put into the plan, removed from their taxable estate, goes into a life insurance policy owned by a trust invested in a hedge fund, can then accrue large hedge fund private equity returns on a tax-free basis. Then when that insured passes away, all of that value is then paid out to the trust, which again is considered out of ownership of the insured. All of that value also misses out of being counted towards the estate, at which point the trustees of that trust, which is normally the family, is to enjoy that value while avoiding massive estate taxes. Suffice to say, this bill is looking to cut into that. They're proposing that such private placement life insurance actually does get taxed, either on the returns that it brings to the cash value in the policy, or that the policy benefits get included in the estate and therefore included in an estate tax liability due by the heirs. It's a wild tax code that we live in here.